Good afternoon, class. Today we are going to be talking about national income accounting, specifically national income accounting 1. And under the national income accounting, we are going to be talking about the definition of national income, concept of national income, the method of calculating national income, and also calculations that are in peculiarity to national income. But first of all, before we dive into the main topic of today, we need to understand what national income is all about. So when we talk about national income simply means the total monetary value of goods and services that are produced in a country as at a particular period of time, usually a year. And when I'm talking about that, we are going to talk about different concepts that are applicable in that peculiarity. But first of all, let's take it again. National income simply means the total monetary value. The total monetary value of goods and services produced in a country at a particular period of time, usually a year. So this is just the basic definition of what I mean by national income accounting. And also, we need to understand what type of commodity we are talking about when we are emphasizing on the monetary value of goods and services. In economics per se, we have two types of goods in a country that are being produced in a country. The first type of goods that are being produced in a country, we have what we call the capital goods, and we have what we call consumer goods. Now, this type of commodity that we talk about, capital goods and consumer goods, depends on the what? On the type of economy that are in place in a country. Example, if a country is a developing economy, they focus more on consumer goods. While if a country is very, very developed, they focus more on capital goods. So in this case, the national income accounting comes in. Whether a country is going to be producing what? A consumer goods or a capital goods. And in that application, we have different types of what? Different types of national income accounting depending on the economic situation of the country. Let's take, for instance, Nigeria. Nigeria is a developing nation, and the kind of what? National income accounting that is applicable will be what? Will be GDP, which I will be vividly explaining under the concept of national income. So we can say the national income that is applicable to USA will be applicable to what? Nigeria, depending on the economic situation. Now, we have various type of what? Or we have the various type of, or we can call it the concept of national income. So the first one that we have is when we talk about the gross domestic product. When we talk about the gross domestic product, which is very, very important. So the first one is gross domestic product. The second one is gross national product. Gross national product. Gross national product. The third one is the next one is net national product. The next one is net national product. Now, the fourth one is we have personal income. We have personal income. The next one we have what we call disposable income. We have disposable income. And the last one is income per GDP. Income per GDP, or we can regard it as income per head. This type of concept, or the concept of national income, is an application with different economic concepts or different kind of economic situation that is applicable to a country. Now, going by that, I will start with GDP. Now, going by the first concept of national income, which is very, very peculiar, is the gross domestic product, which is equals to I will furtherly explain. When we talk about the gross domestic product, from the word domestic, it means something that happens within our environment. And in that peculiarity, it is only restricted within a country. Within a country. So in short, gross domestic product simply means the total monetary value of goods and services produced within a nation. Now, one thing is very, very important when it comes to gross domestic product. It is only applicable to a country that is operating on what? On what we call closed economy. On what we call closed economy. A country that is an open, we can make use of what? Gross domestic product. And the second thing that is very, very valuable is that that country must be a developing economy. Must be a developing economy. So two things are very, very peculiar. The first one is it must be a closed economic country, and the second one is the country must be a developing economy as well. So example of this country is where we have Nigeria being regarded as a what? As a developing economy. And the calculation that are applicable, or the formula that are applicable to GDP is the C plus I plus G, which is regarded as the consumption, investment, and government expenditure. Now, the first one that I made mention of is the consumption, is the investment, and the what? The government expenditure. In an economy, there are three things, particularly all things being equal based on the assumption of economists, that our money used to go in three criteria or more than that criteria. So in a closed economy, their money or the money generated used to what? Be consumed or used to go into three things, which are the consumption, which are the investment, and which are the what? In respect to government expenditure. So going by this, we already know that this kind of economy is a closed economy. And furtherly implementing that, we should also know that our consumption in a closed economy is always equals to A plus BY, where our A is regarded as autonomous consumption, where our B is furtherly denoted as our marginal propensity to consume. And our Y is regarded as our income. So this kind of consumption, or which is equals to A plus BY, simply means this autonomous consumption simply means the type of consumption that will occur irrespective of whether the country is generating income or not. Their consumption that will occur. It is also applicable to an individual who at the end of the day does not have any money that is applicable to him, but at the end of the day, he has something to spend. So this kind of consumption normally occur irrespective whether you have the money to generate it or not. Now, our marginal propensity to consume is applicable to it as well, and also our income. So if we want to denote our GDP now, our GDP will be denoted as A plus BY plus investment plus government expenditure. Now, before we now continue furtherly, I would like to draw us back a little bit that our income is in respect to two things. It's either we spend our income based on consumption and investment, or we base our income on consumption plus savings. So as an individual who is a rational consumer, it's either you what? You go with the first one or you go with the second one. As implemented, you will know that our consumption, like I said, is A plus BY. But what is our saving? If we furtherly take the second one, which is the most rational decision, we are going to say our income should be based on two things, the consumption and also the savings. So going by that, we already assume that, or we already know that our consumption is equal to A plus BY, but what is our saving? We don't know that. So definitely we are going to say our income is equals to A plus BY plus S, with the major aim of getting our savings. To get our savings now, we can say our Y is equals to A plus BY plus S. So using our mathematical approach now, we can collect the like terms. We can say Y is equals to Y minus BY is equals to what? A plus S. We can say Y minus BY minus A is equals to savings. Is this our final denotation? No. So we have to collect the like times. Now, if you look at Y and BY, there's something common among the two. So Y is common, then we factorize Y out, which gives us Y into 1 minus what? B. So we are now left with Y into 1 minus B minus A is equals to what? S. So if I want to rewrite this now, I will say S is equals to minus A plus 1 minus B into what? Y, which give us what? Which give us the formula for savings. So there are two things I want us to denote from this denotation. Number one is that our consumption is equals to what? A plus BY, which shows that the coefficient of consumption is B. While our savings is equals to minus A plus 1 minus BY, which shows that the coefficient of savings is 1 minus B. So in this regard now, we already know that as a rational consumer, we spend our money on either consumption or savings. So in that regard, let's us consider further. I just explained the first one that deals with what? GDP. Now let's take the GMP now. So let's take the GMP now. The GMP is regarded as the gross national product. Whenever we hear the word gross national, it means that it is not only applicable to our country, but it is also applicable to beyond. It's applicable beyond our country. Now, this type of concept simply means the total monetary value of goods and services produced nationally as at a particular period of time, usually a year. Now, there are also two concepts that is applicable. The first concept is that this kind of GMP or this type of concept is treated in an open economy. It's treated in an open economy. And the second thing is that it is applicable to developed nations. That is, countries that are producing something called capital goods. So we apply it to what? Developed nation. So these are the two concepts that are applicable. If you remember our GDP, we said it is applicable to developing economy and a closed economy as well. But here we treat it as what? Open economy and a developed nation. So what is the formula that can be generated for this kind of concept? So we have consumption plus investment plus government expenditure plus export minus what? Import. Now, this represents our consumption. C represents our consumption. I represent our investments. And G represents our government expenditure. Now, if you look at it, the reason why there is differences between GNP and GDP is as a result of the fact that we have X minus M, which represents our export and also import. So we have additionally X, which represents export, and M, which represents what? Import. So the reason why we added export and import is because of the fact that it is not only applicable to it is not only applicable within the country, it is applicable beyond the country. And whenever we are treating any product beyond the country, we have to include export and what? And import. Just like a developing nation investing in a country. So the money is going back to the what? Economy. So they were going to add it back as a what? As a form of export. Do you understand? And the expenses accruable to the country, they are going to deduct it. So it is regarded as what? Import, and export is regarded as what? Their additional backing to what? To their economy. So in this case, whenever we now have X minus M, whenever X, that is the export, is greater than the import, we are going to regard it as net export. So export minus import is regarded as what? Net export. So this is what? This is GNP, which is applicable to an open economy and also a developed nation. That's the second concept of what? Of national income. Now, the third one we are going to talk about is the net national product. One of the ways to identify this concept is whenever we see anything regarding net in economics is regarded as what? It is applicable to minus and also depreciation. So since we have net national product, what we need to do is just to identify that our net national product is equals to GNP, which is the gross national product minus depreciation. The gross national product minus what? Depreciation. Now, if you look at our depreciation, it means economic fall. We can regard it as what? The fall or decrease of economic service of an asset as a result of what? Wear, tear, obsolescence, and inadequacy. Now, one thing is applicable, that whenever we are treating the national product of a country, there is an application of depreciation. So sometimes we don't normally call it depreciation when it comes to national income, but we do call it consumption of fixed capital. We do call it consumption of fixed capital. So the consumption of fixed capital is regarded as CFC. So sometimes when we are treating the calculation, so we might not see depreciation, but we might see consumption of fixed capital, which is the same thing. So in short, our NNP is regarded as GMP minus what? CFC, which means consumption of fixed capital. So in an advanced level, we also regard it as consumption of fixed capital. So I'm going to rewrite the formula now. Don't forget, if we recall, we said our GMP is C plus I plus G plus X minus M. So we are going to add another minus now, which is for this consumption of fixed capital. So minus what? Consumption of fixed capital. So this is our formula for NNP. This is our formula for NNP. Now, going further, the next one we are going to be talking about is the one that deals with our personal income. A lot of students normally misconstrue personal income with disposable income. Now, the personal income simply means the income that occur before the what? Or the income that an individual receives before the deduction of taxation. Let's take, for instance, you work for a government and you receive 10,000 naira at the end of the month. Now, definitely, sometimes the government might say they want to remove tax or income tax. So that income tax being removed can be regarded as what? The income now left after the deduction of what? An income tax is called disposable income. But a personal income normally comes before the deduction of taxation. So in economics, we normally represent our personal income as Y. So anywhere you see something relating as Y, it means what? A personal income. Now, in that regard, definitely, let's talk about disposable income. Disposable income occurs whenever we have income generated or the income left after the deduction of taxation. Now, we are going to represent our disposable income as Y underscore D. So, personal income is represented as what? Y, and our disposable income is represented as Y underscore D. So our disposable income is equals to Y minus T. So income minus taxation. So definitely, if we are going to write it mathematically, we are going to say Y underscore D is equals to Y minus T. Do you understand? So in that aspect, for me to get my personal income now, I will now say personal income is equals to Y underscore D plus T is equals to my personal income. So this is my disposable income formula, and this is my what? Personal income formula. So that's how it is being denoted whenever we have personal income and disposable income. So summarily, we have personal income means what? The income that we have before the deduction of taxation. While disposable income means what? The income that is left after the deduction of taxation. Now, let's take the last one, which is regarded as income per head. Now, the income per head is useful in terms of distributing the economic resources. Now, let's take, for instance, a government want to plan that, okay, we want to know the income being generated or income received by each individual that fall within the category of labor force. And we said labor force in economics fall within 16 to, let's take for instance, 65. These are current labor force. Now the government wants to know, okay, how much is their averagely, what's the income generated or what's the income received by individual. Then we are going to tell them that for us to get the income per head, it will be the current GDP or GMP, depending on the economy type. The GDP or the GMP divided by population. Divided by population. This GDP, our GDP, our current GDP or GMP divided by our population. This population emphasizes on what category of people are we talking about? Is it the total population? We want to know the average income being generated by them, or the labor force? That is, people who falls within the working population. So if they want to calculate that, we are going to calculate the income per head using GDP or GMP divided by our what? Our population. So categorically, we have what? We have understood how we can calculate the income generated per head. So these are the concepts of national income accounting. Now we are now moving on to the next one, which talks about methods that we include or we use in calculating national income accounting. There are three methods we use in calculating national income accounting. So the first one is what we call the income approach. We have what we call the income approach. The second one is the expenditure approach. The expenditure approach. And the last one is value added approach. So these are the three methods we use in calculating national income. So the first one is income approach. The second one is expenditure approach, and the third one is what? Value added approach. What is income approach? Income approach refers to the reward received on the factors of production. What are the factors of production? We have land, we have capital, we have entrepreneur, and we have labor. So the reward that we have on these factors of production are regarded as what? Income approach. So adding all the what reward we experience from the factors of production. So what's the reward for land? We have the reward for land is rent. So the reward for capital is interest. The reward for entrepreneur is profit. And the reward for labor is salaries and wages. So we add all this one together to get our income approach. So that's what we realize when it comes to income approach. Now going by the expenditure approach. The expenditure approach now, we normally use expenditure approach in the concept of national income, using the major things that determine an economy. So example is where we have our consumption plus investment plus government expenditure minus plus what? Sorry, export minus what? Import. This is our what? Expenditure approach. But when talking about value added approach, the reason why we make use of value added approach is not to record some transaction twice. Let's take for instance, you bought a commodity from an organization, maybe a bicycle, and inclusive of the bicycle costs 10,000 naira. And out of the what? Out of the money of the bicycle, it has been denoted to you that it include repair. So whenever you want to repair, maybe within 1 year, you can come back because it has included the amount of it has been included in that 10,000 naira. Now, in order to avoid two method of approach, in order to avoid double counting, definitely they make use of value added approach. Now, in that peculiarity, after you discover that the place you bought the bicycle is too far from you, then you now say, let me just go and repair it. You repair it with an additional 2,000 naira. So what value added approach will do for you us is that it will eliminate double counting. Since that 2,000 naira has been included in the 10,000 naira you bought the bicycle, definitely you don't need to repair the bicycle again. So how can we avoid these mistakes? Because you have already had additional 2,000 naira of that repair. So in order to avoid the mistake, definitely you have to use value added approach to avoid such mistake. So in that peculiarity, this is why value-added approach is what? One of the important methods in calculating national income. So with this approach, I believe that it is best for you to understand methods of calculating national income. So furtherly, we'll be talking about how we can calculate our national income accounting with a question.